So it's really important now, clarity, right? Simplicity, lack of complexity, right? These are the things that are really people are looking for. And you might be somebody who really wants to get into the weeds and understand everything, and that's fine. We'll do that, or your professionals will do that. But sometimes you just want to know, what does something do? What is the result going to be at the end of the day? And that's what's important. We'll do that, and your professionals will help you with it.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Mark Halpern. Mark is the CEO of wealthinsurance.com and one of Canada's top estate planning and life insurance advisors. For over 30 years, he's helped successful families and business owners pay less tax and leave more legacy with a mission. And in just a minute, we're going to speak with Mark Halpern about estate planning, taxes, and strategic philanthropy. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Mark Halpern. Welcome to CREPN Radio.
Thank you so much, Darren. It's so nice to be here.
Well, I'm delighted you're here, and I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So I've been a professional advisor now for just over 35 years, but I like to tell people, Darren, that my start was actually in 1974 when I was 11, and that's when my father died of a massive heart attack at the age of 50. So he was a two-pack-a-day smoker back in the day, stressed out, all that. He was a busy guy, and when he passed away, unfortunately, he didn't have a will. There was very little savings and no life insurance. So my mother was 48 at the time, had to go back to work to support our family. So it was tough. You had to really develop a struggle muscle, which I'm so grateful for, But fast forward, I work with some of Canada's most successful business owners and entrepreneurs, many in real estate and families. And I help them in three areas. One is in estate planning. So just making sure that people's financial architecture actually reflects their financial furniture. Like most people don't have wills in place, or they're out of date. They haven't done any tax crystallization strategy to find out what is they actually own versus what they're going to be sharing with the IRS. Second area that we're involved with is tax mitigation strategies. So we specialize in insurance strategies for high net worth people to be able to come up with the money so you don't have to sell your real estate or borrow against your real estate, have to pay it back. So again, no cookie cutter, every situation is unique. And then the last area that we're involved with there is philanthropy. We help people create charitable legacies, often just by converting tax into charity. And it's an area that we're most well known for, because most people will give to charity when somebody is asking them to sponsor them for a bike ride to conquer cancer, but they haven't really incorporated philanthropy into their estate plans. And there's some great opportunities for people to really maximize impact, minimize tax, and do really good.
No, I love it. That's a lot to cover there, and and it's all something that I think people tend not to like to think about. But what I've learned in life is if you don't plan for it, it's hard to stick the landing. So I mean, that's kind of one of those events that we're all going to meet the end. So whether or not you're well planned for it or not is up to you. So, Mark, just as a kind of a conversation starter, um, estate planning, you had a phrase there, something about the furniture kind of thing. Can you define in just kind of a brief, how do you define estate planning?
Estate planning is really, what do you want to see happen after you die? If you're married, most people, the estate will, you'll die, everything will transfer over to your spouse tax free. So there's no taxable disposition at that point in time. But on the second to die of a husband and wife, there it's considered as if you've sold everything at fair market value. And the government wants they have their hand out for anywhere between 25 and 50% of what you've got if you haven't done any planning. And then it's a question of who gets the rest? Most people would say their family, right? But unless you have something um, planned, like a will that explains your desires, and you need to, a will is the most important document. Otherwise, the government has a formula for how your money gets distributed. Number two is more crucial is what happens if you get sick. There's a greater chance of getting sick before age 65 than dying. You need powers of attorney to allow someone to make not only decisions on your health, but also on your finances. Who's dealing with the landlords and the banks that you're buying your real estate from? Who's going ahead and has their hands in all of your affairs to be able to act on your behalf if you're not available. What else? Ownership. How are things owned? Are they owned in a corporation? Are they owned personally? There are strategies that are in place that allow people to control more of their money or keep more of their money if you have a proper strategy in place in terms of a structure. And then also just things like a basic estate directory, Darren, which is like, where is everything? Most people have all this information between their two ears, but you don't want someone to have to become a forensic accountant to find out where your bank accounts are, where your life insurance policy is, what are the codes, the passwords to your social media, and the world's become much more complicated. So those are just that's estate planning 101. That's without getting really into the weeds around planning. It's just getting your financial furniture organized so that it actually will address the architecture that you're trying to build, which is obviously you've worked very hard and built up something tremendous. Why let it all go to pot by not doing any planning?
Yeah. No, and even like what you mentioned in the beginning about your own experience with your father passing, so soon. I think a lot of us believe that we have time to do this at another point. And on that, I would ask you, what is the most common age you find that you start working with clients, or is
Well,
there a common age?
yeah, there really isn't a common age. I'd say that anytime most people, when they get married, that's kind of, they suddenly feel a responsibility, or they have children, that's a time. Or if they have assets, they've just accumulated assets, that are beyond just, a couple $1,000s in the bank account. So they've got assets. But most people are thinking about this, I would suggest, when they get to 45, 50, 55, 60. When, I'm 64, I kind of feel like you have this recognition and sensitivity that the runway is getting smaller, right? Still a lot to do. I need to get a new car, right there. And I'm thinking, is this the last car I'm going to buy? Like, we always had all these cars, but so when you start feeling that way, you realize, hey, I love my family, or I love these causes I care about. Like, do I want to leave a mess for them? And if your answer is, you don't love anybody, then it doesn't really matter. You don't have to do any planning. But if you love somebody, you have to put in the time. Now, I think what prevents people from doing this, Darren, is it's just not fun. Like, nobody wants to think about death and dying. Nobody wants to think about what it's going to be like in that long-term care facility, when they're drooling on their pillow, God forbid. I'm just saying it's not, I'd rather go golfing. I'd rather, take another trip. But it's not that hard. It really requires just sitting down with somebody, a trusted professional, and having the discussion about what you'd like to see happen, and then making sure that you have a team in place to make sure that they can bring their 2 cents, their perspective on it. You need a lawyer, you need an accountant, you need an insurance professional, you need an investment professional, you need a philanthropic professional, and they have to be talking to each other. They have to, it's not you're sitting in a vacuum in one virtual profession. The world has become far more complicated, and you can't be all things to all people, as you know, Darren. So therefore, it's really important to have a great bench that you can introduce your clients to or work with their professionals.
Yeah, no, definitely well said there. So along those lines of kind of recognizing, when people, should do this, you covered a pretty broad spectrum from, getting married to like 60. I mean, that's pretty much when life's going on, right? Is there a size of an estate where you see that it's more necessary?
Well, look at the more you have, the more it's necessary, right? The
Right.
less you have, the less it's necessary. But even then, you don't have to be Warren Buffett or Bill Gates to get your estate planning together. Regular people, you have a house, you have maybe a vacation property, you have some retirement savings, you've got some, cash around, you've got some investments in, the stock markets. Generally, anybody who has any assets should be doing this. And I would say, it's kind of like, in my mind is once you get to $1 million of net worth, which is nothing today when you buy a house, depending on where you are, you need to put these things into place. And I'll tell you, I'm dealing with a case right now, Darren, the call a couple of days ago, where a woman in her 70s, she had a stroke, and thank God they managed to get to her soon enough to break up the clot, and we thought that was it, but she needed estate planning then. She had some US properties. She had probably about $30 million of partnership equity in a family business. She was a charitable person, but she was also single, which meant that there's a big tax bill that's going to be due. In her case, it was somewhere around $6 million that would have to come off the top. That's a big chunk. And now all of a sudden we're speaking to her and racing around. Thank God her brain's come back. But yes, we can probably help in some way, but we're not going to be able to help completely, in terms of mitigating that tax. But why does it take being in an ICU to sort of say I've got to get this done? So my real message for people is take care of this while the sun is shining. There's far more opportunities and flexibility and peace of mind in this planning. And for most of it, it's just ink on paper. So don't get scared by it. I will tell you that the other side of this is a tremendous peace of mind that comes from knowing that everything's in its right place. It, Unbeknownst to us, Derek, it's renting space in our brain. You talk about
Yeah.
things that keep you up at it rents space in our brain or our subconscious, and it zaps us of energy, whether we like it or not. So get it out, get it done. And again, it's not a one-time thing. You revisit it as situations come up. Life changes happen. But the point is that it's get it done while the sun is shining.
Yeah, no, that's a good point. As far as the degree of difficulty, obviously, somebody's younger, just starting out, doesn't have much as far as assets goes. I'm assuming that's a much easier estate plan. How, my degree of difficulty, or I don't know if there's a way you can describe kind of the level of concerns that somebody, like a business owner that's, been operating a business for years and now, has significantly more assets, or a real estate investor who has, substantial holdings. Is there a way to, I guess, think of, or to recognize how much more, or is it going to be a lot more complicated, or is it it's essentially the same riddle, just, another chapter, or? How do you figure
Yeah,
that?
I go with that. It's really it's the same. However, there's a little bit more moving parts when you're talking about somebody who's got a business, private equity, or somebody who's a real estate investor. Like there's more people, more things attached to it. But generally, it's the same. The good part about those people, though, also is that they have two checkbooks, right? They've got a personal checkbook and they've got a corporate checkbook, a business checkbook, and they love paying for things with that business checkbook. So part of the planning again is I'm sure most of the people who are listening on your podcast, if I ask them how much is your estate tax bill going to be, doesn't have to be to the penny, but how much is your estate tax going to be? I would venture that 90% of them have no idea. They haven't calculated it. Their accountant, who's a good guy, keeps them out of trouble. He's very reactive as opposed to proactive. If you go to him with a problem, he'll fix it very well. He's not going to come to you and say, hey, these are your problems, right? So, it really is having somebody who can be a bit of a Sherpa to ask those difficult questions. But the beautiful part is there are strategies in place where we can help business owners and real estate people turn corporate dollars into personal dollars. It's almost like a tax-free pipeline to do that. So if you knew that there was a way to use corporate dollars to create personal dollars instead of it going through the tax grind, right? Isn't that something that you'd be interested in finding out about? So those are the types of things and the discussions that come up. But yeah, look at if a business owner, if you're working for somebody, hey, you go bye, they replace you with somebody else. But if you're a business owner, you have to also look at things and you're in real estate. Like, what happens to your spouse if you're not around? How are they going to get income from the business? Kids in and out of the business. What have you made plans for? Do you want your son who's running the business with you to be partners with two sisters who are not in the business, where the two sisters every quarter are getting money and they're relying on brother, to provide for them? What about a business partner, Darren? The worst thing is there you have a business partner and suddenly your partner goes bye-bye and now your partner is with his wife and her lawyer. It was bad enough having him as a business partner. You don't like his wife. Now she's your 50-50 business partner. What do you have in place? Like a shareholders agreement, or how are you going to get her 50% of the business when she's not actively involved? What about the bank? You borrowed money from the bank. How are they going to feel if the main guy is not in the cockpit and now somebody else is? Is this person who's maybe 20 years your junior, doesn't have the same, wisdom that you have? Are they going to feel comfortable having millions of dollars of borrowings with that person? That's stuff that has to be addressed. Your employees, your key people. What happens if you go by and you haven't arranged anything? Is it possible that your competitor is going to pick up your good people? And bring them over there. And then, of course, there's just the IRS. They've got their hand out, and it's really important to know that, after your family, they are your second largest beneficiary. So find out what that is so we can figure out ways and use some of the technology and the legal instruments that are available in America to be able to mitigate that tax. So again, you mentioned about the sensitivity of a business owner, a real estate person versus another person. Hopefully, I've given you a bigger picture of some of those complications.
Yeah, I appreciate that because there's a degree of difficulty that you go through as you accumulate more keys or more assets or whatever. I mean, there is a degree of difficulty in trying to settle your affairs, and it's important to be aware of that. Um, as far as the you mentioned the IRS, I mean that's the boogeyman that's always waiting. Can you speak to any kind of what kind of a timeline does one or what is the timeline upon your demise that your estate has to be settled? Is it when you file taxes in the for the year in which you died?
Yeah, it's called a terminal tax return. So it would be in that
Oh,
year that they would go ahead and again, if you have a spouse and you've set it all up, there's not going to be any tax. Everything's going to roll over to your surviving spouse tax free. But let's say it's a second marriage, right? Which is not too uncommon. It could be a third marriage too. You didn't get it right the first few times. Do you want your second wife to be the beneficiary of your assets tax free when she has her own kids and you have your own kids? No, so that whole terminal return is going to be very important to direct where you want your assets to go. And if things are owned jointly, right? So you've got a home that's owned jointly, or a recreational property that's owned jointly, or a corporation that's owned jointly with your spouse. There's less red tape there because they're still, sort of have the rights to survivorship on those assets going forward. But again, it's just best to speak to a professional. They do this all the time. Get a competent estate and tax lawyer involved to make sure that you have wills and powers of attorney up to date, and that you've looked at sort of ownership structures, and also that you've crystallized what's the tax going to be. And for a lot of people, Darren, they are going to have more money when they die than what they have today, especially if you're in the real estate business. True?
Sure.
So that means that they're really the custodian or trustee for the next generation. But what they don't realize is that they're partnering with the IRS on that money. So people have to go through a financial planning process to get a big check mark that, hey, they're never going to run out of money, right? And they know that. But here's the tax bill today, and here's what the tax bill will be at 100. And here's all their never spend money that they're never going to spend, but that they're paying taxes on. Can we use some of that money to preserve their estate with things like life insurance and structures, or for charity, to turn that money into charity, or both? So it's very easy once you go through a process. A lot of people don't have a process, they buy things. It's very transactional. Somebody says, hey, you should buy some insurance. This is how much it is, and they buy it. But it doesn't necessarily fit, what the estate really needs. It's more of just, as I said, that piece of furniture. And it's really important first to make sure that you get your structure in place. Like what does it look like and what you'd like to see happen?
Yeah. So with respects to, doing the planning, and we've talked about, estate planning is the overall kind of topic, and which part of that is tax planning. And then you mentioned the philanthropy, how you would like to benefit, whatever organization you may want to help. Um, if somebody's saying, okay, I got to do this, um, Mark, how much time should one expect it to take to kind of grind? And I say grind because it's something they don't want to probably do, but they recognize they have to do. How much time should one plan on it taking to kind of, you know, ballpark time wise? How much time would you expect it to take?
Depends on how much stuff they have, right? And
Yeah,
how much complexity they have. If they
right.
just have a house and some bank accounts and investment accounts, and that doesn't take so long. But when you have more stuff, there's more complexity. I'd suggest that, having that first meeting would really be, I would just say, let's say an hour, and it can all be done on Zoom. Just basically, it's like going to the doctor, Darren. If you went to the doctor and he gave you a prescription before a diagnosis, that's called malpractice, right?
Right.
So it's really just finding out, what do you have, getting an idea of your assets, what you paid for them, what they're worth today, how they're owned, how they're structured, family members, are there any issues around any health concerns with people? Maybe they're a trust for health. Spendthrifts out there, you can have kids get gambling. There's so many different things, but just gathering all that information together, and that's part one, and that could take an hour, and maybe a follow up to get more information or answer more questions. Once we have that, we put that all into, I call it like the sausage machine in the laboratory, and what comes out is, here is your life. We now play back to a client. This is everything you've told us. We just want to make sure we haven't missed any ones in front of numbers or zeros at the end. And here's your situation. You've never met us before. Here's your default. This is what it's going to look like. Happy, not happy. Now we can go ahead and say, here, let's layer on top 5, 10, 15 different strategies above your default, and let's measure the ROI on those versus you doing nothing. And then let's figure out what's the most biggest priority, what makes the most sense, and let's work with your professionals to implement some of those strategies. That's it. There's never any obligation. In our case, we don't have a meter running. We have enough confidence in what we're doing that, we work through referrals and people like us and the people I work with in the United States as well. I've got many Mark Halperns that are my associates and colleagues there that I introduce people to as well. And we have enough confidence in what we're doing that if we just become part of the team, we can get things done. But that's, the only caveat is that people have to invest some time and they have to disclose everything. You can't go to a doctor and not tell them about this thing that's growing on your under your armpit. You know what I'm saying? Like, because you're embarrassed about it. So as long as you take the time and you disclose everything, you can have the success that you're looking for.
Yeah. And then as far as you mentioned in your situation, the it's not such a cost thing for the time, but I'm assuming you get compensated for the sale of whatever the solution is, whether it be a life insurance policy or what have you. Is that accurate?
Yeah, in our case, we there's a lot of work to be done, and we love to do it. It's we do it all the time, so we don't mind doing all of that. And if that's all we're going to do, but you're a do-it-yourselfer, so then we would charge for that process. But 95% of the time, people need some sort of strategy put into place, and if that's the case, then we help navigate that with your professionals. But we specialize on the insurance side, right? So if we place insurance like you, Darren, we'll get paid, we'll be compensated by the insurance company, in which case the client will not pay us fees for that work. The other way that we get paid, though, is two other ways. One is sometimes, and hopefully we get around to talking about it, is we'll just save them a lot of tax, right? And or maybe turn tax into charity. And if that's the case, then we'll just charge a small percentage of whatever you saved in tax. That's how we'll charge. So we can charge anywhere from 3 to 7% of the tax savings. If we save you $1 million, 3% is 30,000 bucks. Not bad. I would do that all day long if I could spend 30,000 to save $1 million. And then the last way we get paid is just through referrals. People like us and they think that we bring value, and we'd like to be introduced to their family and friends who are in the situation like themselves.
For somebody that has done their estate planning and answered all the questions and set all the solutions in place, how often should that be reviewed to keep it current?
Yeah, it's a great question, and certainly life cycle events are times to review it, right? Beneficiaries died, you sold something, somebody got married, you know, any type of life cycle thing would be a moment to pause and say, is this going to impact my planning? But we generally say that you should be reviewing your plan at least every 3 to 5 years. Again, unless there's some big change, you've sold a big real estate portfolio or you sold the business, then it's a time that you're going to look at it sooner. Or you've had a divorce. Those are all types of things. So those life cycle things. So nothing really carved in stone on that. It's just that you need to be on top of it and realize that if at the end of the day they were going to put your estate plan on the front page of the New York Times business section, right? Like, here's Darren Gross's plan, right? And this is what he did. Would you be proud of it? Does it really speak to who you are and what you believe in and the people that really care about you? And if you can say that, yeah, I would be, hey, two thumbs up. But most people can't. They don't even have a plan, right? Or it's sort of half baked or quarter baked. So the challenge is getting it over the goal line. As you said, Darren, people just are busy. We're in a busy world and everybody's got ADD. Let's face it. If you send me a 3 paragraph email, I'm going to cancel you. Like, how dare you? You think or if when you get one of those WhatsApp messages and it says it's 3 minutes and 22 seconds, like, are you out of your mind? Like, I don't even have a speed fast enough to go through that. So it's really important now. Clarity, right? Simplicity, lack of complexity. right? These are the things that are really people are looking for. And you might be somebody who really wants to get into the weeds and understand everything, and that's fine. We'll do that, or your professionals will do that. But sometimes you just want to know, what does something do? What is the result going to be at the end of the day? And that's what's important. We'll do that, and your professionals will help you with it.
Got it. And as you mentioned earlier, talk a little bit about tax and some of the strategies and how you work and can help your clients.
So let's just talk about because you have a lot of real estate clients, who are listening. You have to ask yourself, are you a buyer and a holder, or are you a buyer and a seller? Right? There's some people who exit and we're on to the next thing. Most people, at least that I know, who are in the real estate business, are buyers and holders. Been a great asset for them. The challenge is that it's an appreciating asset, and what they do is, they'll borrow against the equity in their property to buy more property, and they build up something. But if they are a holder, that means on the second to die, the government's going to consider that you sold everything at market value at the time of your death. And they're going to want a significant percentage of whatever the growth has been on your portfolio. That means your cost base, what you paid for it, what the market value is. They're going to want, somewhere between 25 and 50% of what you've made. So most people don't know that. Again, every state is different, federal, state, whatever. So what are you going to do in that case? What are you going to do about paying those taxes? You either have the cash on hand to pay them, which most people don't, because if you're an active investor, you're using that money to invest more, right? Or your family's going to have to borrow money. So actually leverage those property values in order to come back and pay the taxes. But meanwhile, they have to pay the money that they borrowed back, and it's not a deductible interest. And who's going to lend it to you? Or the saddest part is you have to sell assets. Which building are you going to sell first? Which cottage are you going to sell first? And is it going to be a great time to sell it? Right? If it's some sort of distress sale, a buyer's going to know that. And is it possible you won't get 100 cents on the dollar? So, or you can do things like acquire insurance, life insurance. Life insurance, again, for very wealthy people, they have like a lot of psychological baggage when it comes to life insurance. They look at it as a grudge purchase, like their car insurance or house insurance. They had it when they had a mortgage and they had kids at home and they had to feed them and send them to schools and things like that. But life insurance is still one of the only tax exempt assets that we have around. Everything else seems to be taken away by the tax department all the time. So using insurance, you can actually create money for pennies on the dollar, right? As opposed to 200 cent before tax dollars to pay the $1, the $1. Or you can actually even use financing strategies to actually acquire insurance and still have your money to invest in real estate, but you also still have the money for your tax purposes using the insurance. I call it virtual real estate. We can talk about it in a moment, but that's one idea. That's the most simple way that wealthy people use life insurance. And it's definitely something that's worth people's attention.
So this virtual insurance, you got me curious here. What do you mean by that?
Good. So you buy and sell real estate. I know you risk you insure it, Darren. But if you go up to a successful real estate family, they have real estate. Well, I'm in the real estate business as well, but my real estate is virtual real estate, and it's just a good analogy to understand it. In your world of real estate, you have a market value and you have equity. And you can borrow against that equity to reinvest and buy more properties with. Because you're borrowing to invest, you get to deduct the interest and some other costs. But basically, your market value continues to go up on your real estate portfolio. Hopefully, your equity goes up, you pull money off the table, and you just rinse and repeat and do that all the time. In my world, when I talk about virtual real estate, life insurance has the same sort of attributes. It has a death benefit, which is like the market value, right? Let's say you're buying $10 million. And it also has something called a cash surrender value, which is like equity that you would have in your real estate. So what you can do with those two things is you can put money into this life insurance policy. Let's just say it's $500,000 a year for 10 years. I'm not telling you how much it's worth or what, but let's just say you're putting in $500,000 a year. You can then go to the bank and borrow $500,000 from that cash value and now put it back into your investment portfolio. So you have your insurance. Now you're borrowing against the cash value, the equity in that policy to reinvest, and you're deducting the interest. But now you have your insurance in place and you have your money to invest, but you also have a debt that's owed to the bank. At any point in time, you could always pay back that debt to the bank and just rinse and repeat, do it again and again. It's like having a personal line of credit. Or you can structure it such that you don't have to pay back that debt to the bank. The life insurance, which appreciates, will have enough sufficient capital in it to pay back the bank and still have the money left over for your family to take care of any of your tax, exposure on death, or estate equalization or philanthropy or whatever the case might be. No cookie cutter. So again, that's just another way of acquiring insurance that the high net worth like to do.
No. Yeah, it's always fascinating the strategies and ways you can use life insurance for various things. I think the simplest way is the term policy. It's good for this many years, this level of benefit, this is the cost. But that's clearly the what you're talking about is kind of a ninja kind of a move as far as, and I say ninja, I mean it's just not the term policy.
Yeah,
It's just
it's
yeah,
not
yeah,
that's not for everybody,
yeah,
Darren. That's for somebody who's got a tax bill, who's
yeah.
comfortable borrowing, who has a healthy place to invest the money they borrow, and has the ability to deduct interest, and is healthy. Like there are different types of insurance, but you're right. Just the term to 100, the life insurance to 100, that's very good if you have a crystallized tax bill. In other words, you've done a freeze and you know exactly what your tax bill is going to be. Otherwise, those other insurance policies are not going to continue to grow as your assets grow and as your taxable, exposure grows. So again, no cookie cutter.
Got it. Hey, Mark, if we could, I'd like to shift gears here for a second. As we've been talking, and by day I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there are three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we're not able to avoid nor minimize, we look to see if we can transfer the risk. That's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be their clients, could be tax law, could be the economy, political, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Mark Halpern, what is the biggest risk?
Great question, Darren, and I'm glad you're asking it. So I'm on a bit of a mission, Darren, and that is I want to inspire and educate professional advisors to be incorporating this insurance and philanthropic planning into clients' estate plans. I'm on a mission for that, okay? Because people don't know about it. So, what is the main thing for me that the biggest risk is that everyone should know that they have three possible beneficiaries to their estate. Three. One is family, one is the tax department, and one is charity or impact. And each of us can only pick two of those. Which two would you pick? Most people would say, I take family and I take charity. So, with proper planning, you can be remembered for leaving a lot of money to charity as opposed to writing a big check to Washington. And this is all legal, all given the kiss of blessing from the tax department, that people don't realize that charitable donations on death can actually be used to mitigate up to 100% of estate taxes. 100%. That means for every dollar of tax that you owe, and you give $2 to charity, you turn $1 of tax into $1 of charity. Now you remember for giving $2 to charity as opposed to $1 to the government. So that's the risk, is not getting to that, as I've said before, while the sun is shining. Because a lot of people have become very successful in their life, but they want to become significant. And your kids, this is not about disinheriting the family. Of course, charity begins at home. Giving to charity is not about disinheriting your kids. It's about adopting causes that you care about and disinheriting the tax department. And that gives people a tremendous feeling of accomplishment in life. I've had clients who've cried thinking about the fact that they have not done anything yet of significance, right? So if we can use house money, money that's on the table that doesn't belong to you, to make a difference in this world, how great would that be? And we have a pretty ambitious goal. Our goal is to create $1 billion a year of charity. We're building a national community of 100 professional advisors and charities. And if each of us are creating $10 million of current charity or future charity through legacy giving, often just by converting tax into charity, you've got 10 million times 100. That's $1 billion a year. And our goal is to have that in place by 2030, the end of 2030. And we've already got about 2 dozen already attached to this. So it's a great thing that gets me up in the morning and I get excited about. My biggest risk personally now is not having enough time to actually execute on this goal, because that's my mission. And it's a big risk because nobody else can do it. It's only me. So I have a lot of ambition around that, and it gets me very excited. And I love to see helping advisors. I have an amazing mentoring coaching program called powerofplatinum.com. It's been around for 5 years now. Over 200 advisors have gone through it. They become experts in what we're talking about. And the nice part about that is the fees that they pay actually go to my charitable foundation. So it's a way for me to create more charity, help more advisors, and do good in the world.
Awesome. Mark, where can the listeners go if they'd like to learn more or connect with you?
Sure. So they can go to our website, wealthinsurance.com. They can send an email to me at Mark, M-A-R-K, at wealthinsurance.com. I'm happy to have a conversation, Zoom, phone call, introduce you or find the right address for you in America, depending on where you are. You have to just understand your situation best to know who would be the best fit. But, the real advice is don't think about it, just do it. It's as I said, the peace of mind that comes it's priceless.
Awesome. Mark Halpern, I cannot say thanks enough for taking the time to talk. I've enjoyed it, learned a lot, and I look forward to doing it again soon.
That's great, Darren. Thank you so much for having me, and we can have more conversations in the future. And thank you for allowing me to be your 560th guest on your podcast. I thought that was kind of cool.
No, I'm delighted it was you.
Congratulations to you. Really, that's amazing that you're really helping so many people by sharing your wisdom and knowledge, and the people that you bring on to help your clients, who are obviously very fortunate to have you on their team.
I appreciate that. All right. For our listeners, if you liked this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.